What does 1245 mean?
1245 is a classification code in the tax code, and 1245 assets are personal property assets. It's the stuff that you can take advantage of when you do a cost seg study.
This is important for everyone to understand. Not your personal residence, but if you've got, let's say, a second piece of real property, like a residential that you're Airbnb-ing it, short-term rentals and things of that nature, that's bringing in income, you can do a cost seg on that building. And of course, you can do it for medical dental condos, medical dental buildings, any commercial building, apartment complexes, anything that, as Wes mentioned, that generates some revenue, but not necessarily your primary home. So that's an important. Hello and welcome back to Ali Off the Record. I'm your host, Ali Oromchian, and today's guest is someone who is passionate about saving you money by unlocking huge tax savings through the power of cost segregation. Joining me is Wes Mabry, who is the founding partner of 1245 Consulting. He's a certified cost segregation professional, and over the past 17 years, he's helped clients defer more than $2 billion in taxes. Don't tell the IRS he's done that. They might actually try to kill him. In this episode, we're going to break down what cost segregation actually is, how it works for doctors who own their practice buildings, and why it can mean the difference between straight line depreciation over decades versus massive tax deferrals upfront. The best part is that it's all legal and encouraged by the IRS. And we're going to also talk about the benefits, the limitations, and what every doctor needs to know before using cost segregation as part of their tax planning strategy. So stay tuned. You're definitely not going to want to miss this one unless you like paying taxes. Hey, Wes, it's great to have you on today. Thanks for joining us.
Hey, Ali. How's it going, man? Stoked to be here.
Yeah, same here, man. I'm so excited about our topic today because it's one of the things that I think our audience is just going to absolutely salivate over, because our doctors, as you know, they're mostly practice owners. There are some who are associates who are looking to own a practice. But one thing they all have in common is they want to minimize their taxes, and they all love buying real estate. And as you know, from all the things that I do, that I teach across the country, we are big believers in real estate being a big bucket for wealth building and whatnot. And so we're going to talk a lot about cost segregation, but give us a little bit of background about, your career, how you got into cost segregation, and then we can kind of go from there.
Sure. So next year will be my 20th year in cost segregation. I was a commercial real estate appraiser for a while, and I was working for one of the only firms in the country that was using commercial real estate appraisers to do this cost segregation stuff. So this is like early 2000s. And as you know, real estate appraisal kind of focuses on valuations. One of those valuations is the, sales comparison. It's like, what did your neighbor's house sell for? That's probably what your house will sell. Yeah. Another one is, NOI divided by cap rate. That gives you, what the market should yield for a particular property. But the third one that a lot of people don't know about is you actually can value the individual components inside a building. How much is the roof? How much is all the framing? How much is the slab? And that right there is the basis of a cost seg study, understanding the pieces. So I worked there for about a decade, got hired away by an engineering firm on the East Coast that did a lot of cost seg work across the country. And while I was there, Tax Cuts and Jobs Act of 2017 came out, ushered in 100% bonus depreciation on used assets for the first time in history. Yeah. I had a quick conversation with my wife, quit my job, started 1245 Consulting, ran that by myself for as long as I could, which was only about 2 years. And then it just really took off to where it is today. We've got a staff of about 15. We do hundreds of these things every year now.
Yeah, yeah, absolutely. And you and I connected when we were buying our building, and you did such a great job of that for us. I'm always forever thankful for that, because it makes a huge difference. And you know what's funny, and we're going to talk about this in a little bit, because my CPA at the time recommended against doing the cost seg, right? They recommended against it. And we're going to talk about that because it left a lot of money on the table at the time. And once you and I connected and you did it, and we changed CPAs, and it was very much bad advice that we had gotten. It was probably one of the worst pieces of advice that I think I've ever gotten as a professional from another professional,
Oh, it's tough
And
to hear.
yeah. It's crazy. But I have to ask you, what does 1245 mean?
1245 is a classification code in the tax code, and 1245 assets are personal property assets. It's the stuff that you can take advantage of when you do a cost seg study. The inverse is a 1250 asset. That's the stuff that takes forever to depreciate. So 1245 asset is the stuff you get off your books really quickly. And a 1250 asset is the stuff that you don't want, but it's inherent in all real property purchases too.
That's a great name then for your consulting company, because every time somebody searches up 1245, you're going to come up.
There you go. I've always kind of liked it because I never wanted to be like the 100th firm that was,
Yeah.
cost seg this or cost seg.
Right. Yeah.
So it's a little bit of a branding edge, I guess, if you will.
Yeah, no, it is. And now I now know that. I didn't know that was the section in the IRS code. So that's perfect. Or maybe not the section, but the kind of assets. So, all right, let's take a quick step back for the audience, because like I said, a lot of people want to own real estate. They do own real estate. They've heard about cost seg. They may have even like Chat GPT did, what is cost seg? But what they get and what maybe they understand is very different. So can you explain, just at a very kind of high level in plain English, what is a cost segregation study, and how does it differ when somebody doesn't do that versus somebody who is going down their path of doing that, as far as their taxes and stuff is concerned?
Yeah, happy to deconstruct that for you. So the default method is what's called straight line depreciation. You just take what you paid for the property. And in this case, we'll just assume a medical office building, and that's a non-residential facility. So you divide your basis there by 39 years, and you write it off one piece at a time for almost 4 decades. What a cost segregation study does is takes a look at the building, identifies all of the pieces, assigns a value to them, and then takes those values and makes a determination on whether or not you can write it off very quickly, perhaps over a 5-year period or even a 15-year period, and then applies what's called bonus depreciation regulations to those shorter life assets. So short life assets, everything under 20 years, on just about anything you buy, 30% of it or so qualifies as a short life asset. You can speed up depreciation on that. Depreciation is a non-cash expense. It's a deduction or an offset to income. And so what this is doing is deferring income tax payments, basically kicking those tax payments down the line just as far as you possibly can.
And can you do it only on like commercial real estate? Is it available for other real property?
Any income producing property.
Okay.
So this would include rent houses. This would include, of course, apartments. It's probably more than anything. We do apartments. It's a very heavily transacted asset class.
Yeah.
But also certainly, non-residential facilities as well, which just runs the span of everything from a simple metal storage building all the way up to, a biotech facility that we're going to be looking at here in a couple of weeks. I mean, it's anything that's generating income and is a real property affixed to land. Can't depreciate land, but yeah, man, you can run it on anything, not your personal residence.
Yeah. So this is important for everyone to understand, not your personal residence, but if you've got, let's say, a second piece of real property, like a residential that you're Airbnb-ing it, short-term rentals and things of that nature, that's bringing in income, you can do a cost seg on that building. And of course you can do it for medical dental condos, medical dental buildings, any commercial building, apartment complexes, anything that, as Wes mentioned, that generates some revenue, but not necessarily your primary home. So that's an important.
That is a
topic
good distinction. And another component that's, I don't want to call it unique to the medical space, but something that's common that we
Yeah.
see are condos, where the business or the practitioner will actually own the real estate inside the walls, not so much outside, none of the parking area and any of that.
Yeah.
They may own a fractional piece of that, but condo is also something pretty popular in the medical and dental space as well. Condo ownership, you can accelerate depreciation on that property as well.
Oh,
Um,
awesome.
Primary to rental conversions, we've gotten a lot of this over the years. Folks will say, the house is great, but we don't need this big of a house anymore. It'd be an awesome rental. So
Yeah.
they buy something else, move out, turn their old house into a rental. It's called a primary to rental conversion. And then you can spin up a cost seg study on that because you're no longer living there. It's actually now an income producing asset.
Oh, nice. Okay. And what about like homes that people buy to flip? Like they buy a home, they renovate the inside, and then within, let's say, a year, 2 years, they don't ever live there, but they're just flipping it. Does it make sense to do a cost seg for something like that? Or is there something like recapture provisions that come in that maybe doesn't make it as profitable or makes sense to do?
Recapture is a real thing. Happy to drill down on that. But in a situation where you're just flipping over a property, you're not using it. And what depreciation does is it tracks wear and tear over time. So if you're going into the market, buying an old asset, putting new components into it, and then releasing it back out into the market for sale, you really have kind of what some people may recognize as like a cost of goods sold situation here, and not so much the tracking of wear and tear. So you can take deductions on flips because it costs money to get that thing put together, but we're not setting it up for use in a manner which allows it to be depreciated.
I got it. Okay. Okay. Perfect. Now, I know, remind me where you're located, Wes?
I'm a Houston guy.
Okay. So you're in Texas, but you work nationally, right? So one question that we sometimes get is, well, I'm in New York, Florida, California. Do you have to be local to do these cost segs, or can you do it for anybody across the country?
Coast to coast all the time. We have a network of inspectors that we spent the last couple of years training. They are out of the commercial real estate inspection space, and we've identified some talented people there, put them through a training program that we've developed, and then we will kind of have them as our boots on the ground, our eyes,
Oh, nice.
our lens there. We can use some remote technology to work with them. We can also use, it's kind of like a FaceTime call, but it's out of the construction industry, so we can zoom in and take pictures as the call goes on. We also can do it with property managers. And there's other times where we'll do like a desktop analysis on very simple buildings, particularly single family homes.
Yeah.
And then there's times where we actually still get on a plane, fly out, and go visit the property.
Yeah. Okay. Awesome. Yeah. And just for everyone to know, in full disclosure, Wes did, a couple of our properties here in California, and it was super smooth. He worked with our property manager. Like you said, I think you at some point you had somebody come out and review, the building and inspect it as well. And then you did the study, and it only took a couple of weeks, I believe it was. And so it was very smooth, very easy to do. So it's good that you also do this nationwide. So
Yeah, I appreciate that. It's good feedback there. I used to spend, I don't know, 120, 140 nights a year in a hotel somewhere doing this. But as you know, when you're running a business, that's just not tenable. You've got a business to operate. You've got to kind of delegate some of that. I still get out there and look at some properties, but when I go, man, it's usually complicated stuff.
yeah, and maybe you go to locations that are a little bit nicer and take the family with you. Make it a weekend out of it.
No, it's absolutely true, man. We're always kind of waiting for that shopping center in Hawaii to come across my desk.
Yeah, exactly. Yeah, we got to definitely do one in Maui, and then maybe do one in Miami.
I mean, they're 5 and 7, but it's never too early to start.
Yeah, exactly. Okay, so now remember what we talked about when we began. Like, I got advice from our CPA back in the day to not do a cost seg, and what he said to me was his point was, all you're doing with a cost seg is speeding up, right? The depreciation that you would still be able to get over the life of the property, 39 years or whatnot, which when he said it the first time, I thought, okay, well, maybe it's not so valuable. But as the more I did my research and whatnot, obviously speeding it up is very valuable. And that's why so many people do these cost segs. But what's one misconception that you hear from CPAs that are advising people to maybe not do cost segs that you wish you could just, clear up right away, for people who are listening, if they're getting that advice from their CPA?
That misconception would be, it's not so much our ability to find the depreciation. We can find depreciation opportunities in any building. They all have pieces to them. Many of those pieces qualify for the accelerated depreciation part of an analysis, which is where you draw the benefit. Remember that 1245 stuff we talked about earlier? The bigger question is, can you use it? Or what are some strategies you can put into place to be able to use it? And that's when we start talking about real estate professional status for taxation purposes. And many times we'll see tax professionals, particularly working with folks on a higher income side of the spectrum, just say, look, you've got a W-2 job. You don't qualify as a real estate professional for taxation status. So we can load up all the depreciation we want, but you're not going to be able to use it for anything other than maybe the rents that you're receiving. But they fail to strategize that maybe there's a spouse in play that can qualify for that real estate professional status. And then we're pulling a massive lever and offsetting huge amounts of income. That is tax planning and not just tax preparation and filing.
Right.
When we see folks maybe pivot away from someone who's been doing it the same way for a really long time, it's because they're not strategizing. So I would say that the most frustrating misconception we run into is the notion that just because one individual in a joint tax situation can't use it means it's completely off the table, and it's just not.
Yeah, and if somebody does hear that, is it a good idea for them to talk to you and then maybe have you speak to their CPA? Like, do you do that kind of second opinion and kind of get into the weeds, or is that not part of what you do?
Here's how we would get involved. We would let them know how much depreciation is trapped up in the real estate holdings by running a preliminary analysis. And I have an entire department that does these things all day. There's never a cost to do it. Then what that will provide the taxpayer with is a pretty handy one-pager that they can then take to their tax professional and say, look, we've got, $400,000 in depreciation trapped up in our real estate holdings. How can we enjoy this depreciation as taxpayers? And then that engages a conversation with the tax professional that can be pretty productive. And they'll begin to explain to them what they can do to be able to use the losses, how they can structure ownership to take advantage of the losses. But we don't file taxes here. We work in conjunction with people that do. And the individual that has the big picture is generally the tax professional. So the chair we sit in is arming the taxpayer with information to take to their tax professional. If that makes sense.
Man, that is huge. That is huge. For everyone who is listening, I want to make sure you didn't miss what Wes just said. He said that if you're getting some advice from your, EA or your CPA or anybody that says, hey, this may not be a good idea for you, or maybe you're just curious because you have got a building and you want to know what the potential tax savings could be from this, is that his firm does a preliminary assessment for you that will give you a general sense of what that savings could be, and it's at no cost to you. And so you could take that then to your professional tax preparer or tax planning expert and say, hey, here's some preliminary analysis. Do you think this would be helpful for me? And if they say yes, then you could do the full analysis and get all the benefit from it. Because, at least in my situation, and I'm sure I'm not unique, that number is probably even more when you do the full analysis. So
we estimate conservatively for sure. And, oftentimes that, we'll be talking about one specific building, structure, or asset, whatever you want to call it. And they'll say, oh, well, we bought some a couple years ago and we never did this study at that time. And I'm like, well, that's okay. We can go back in time and claw that depreciation forward. I mean, you can't go back and get credits for it, but there's a process in place to go and pick up missed depreciation that wasn't accelerated when you placed an asset into service. And we find that tails in oftentimes with the folks that aren't, working with a strategist that likes to pull heavy on that accelerated depreciation lever. So we can go back in time, capture missed depreciation, and then we can certainly analyze stuff that's a little more prospective or kind of about to be on their plate.
Well, I'm glad you brought that up because that was my next question. Like, when do you recommend somebody do a cost segregation study? Is it after buying a building? Is it before? Like when is
Everyone
it? They maybe do it.
It's okay to get like preliminary numbers before, but you don't want to engage the study until you have control of the property, until you close, because things fall through all the time.
Yeah.
The tax year it was originally purchased, or the tax year in which you make the purchase, is the most advantageous time to take advantage of cost segregation, because what we're talking about here is it's a tax rate arbitrage. It's a time value of money play. And the sooner you can begin the deferments, the more time you have to accumulate returns on the taxes you're not forking over to Uncle Sam. Secondly, would be whatever year you are in the cycle, as long as you don't plan on disposing of the asset within the next 2 or 3 years. So if it's a long-term hold, you can do whatever you want. If you do the analysis the year you buy the property, and maybe you're thinking, I don't know, I'm thinking about exiting the business in the next year or two. I'll have a big long-term capital gain at that time. Maybe I'll do the study then. You can certainly do that, but it's important to know that unused losses aren't lost. They're suspended and carried forward. Right. So if you made 300 on the year, but we came up with $1 million in losses, you don't lose out on the 700. Right. It gets suspended to the next tax year where you can use it again, assuming, of course, you can qualify.
Yeah.
So first, the year you make the acquisition is important. We also have clients that continually rehabilitate their properties. This is more common in the apartment space than anything. Units turn over, people move out, they'll go in, make improvements to the property. Those are additional opportunities to take losses using cost segregation. You can segregate those capital expenditures, those improvements to the property. We do those all of the time. And you can also take something called disposition on certain assets that you throw away. So you've got to be mindful of it every year if you're putting money into a property, because there are opportunities to take losses on stuff you throw away and stuff that you add to the property.
Oh, that's awesome.
Do it in the year it happens.
Yeah, that's awesome. That's awesome. Actually, I'm glad you brought that up because, when we moved to our new building and we did some work, the landlord, which was an entity that we created, did some of the work. You did that study. I didn't realize that's what it was, but you did that study for us as well to help us sort of expedite some of the improvements that we did to the building. So, yeah.
There's a special carve out for non-residential facilities. So every medical office building, every dentist office that you've ever walked into is a non-residential facility. No one's living there. It's commercial property. And there are provisions in the tax code that treat things differently if you stay inside the envelope. If you bought a dental office, the doors that are in there when you buy it are what's considered structural. You have to have those doors. There's no case to be made to accelerate depreciation on those doors. That's going to be a 39-year write-off on them, no matter what you do. However, if you replace that door, then something called qualified improvement property regulations come into play. That replacement door is considered a 15-year asset because it's inside the envelope. 15's less than 20, everything less than 20 qualifies for bonus. It's an immediate write-off. Super handy. Nice. If you're in the non-residential space.
Nice. Oh, I love
We
this.
send out emails at the end of every year to our folks that are non-resi, and we let them know, like, hey, if you did any work on this, even if it's just a couple $1,000, let us look at it. First year, we do it complimentary. We'll analyze work that you did on the property. I think you and I had a discussion about that a couple weeks ago.
Yep.
But then beyond that, we charge a fee to look at capital expenditures and put a study there.
I love that. Yeah, and for a lot of those of you who are doing exactly what Wes just described in your units, I mean, this could be hugely beneficial. So, okay, great. And now we have some clients who say, I'm worried about audits. Is this going to cause an IRS audit? Is it risque? Let's talk about that. Is this at all a risky venture? Is it skirting the lines anywhere?
It is prescribed by the IRS. They tell you how to do it in what's called their audit techniques guide. They have a manual that's published. It's for their field agents, but it basically says, like, here's how you go and analyze a cost seg study. And if you have a cost seg study that's put together with that in mind, then you are playing it kind of right down the middle of the fairway. As long as you don't get aggressive with decisions on what qualifies as a short life asset, what qualifies as a structural component. It's prescribed by the IRS. It's based on tax law. 2%, sub 2% is the chance of being audited for any taxpayer for any purpose. So it's highly unlikely at any time that you're going to get audited. We include an audit defense guarantee with all of our studies at no extra cost. It's just what we do. If you're going to put a work product out there, sign your name to it, you ought to be able to defend it. We did 6 of them last year, 0 disallowances. We've got 2 big ones going on right now.
Wow.
So it's something we do all the time. It happens. If you do enough of these as a cost segregation professional, it's bound to happen. Somebody's going to get pulled randomly. I've never heard of someone getting audited because of a cost seg study, but plenty of times taxpayers will get audited, and they have taken accelerated depreciation positions. The IRS is going to want to look at that. The first question they always ask is, how'd you get to a land value?
Right.
Follow their guidance on that. So we've never had to give anything back on land valuations. And then from there, it's, why did you classify this in such a way? We provide court cases as reference right there in the back of the reports to help move along that discussion. You may remember seeing in the news a couple of years ago where they allocated several $1 billion to the IRS to hire new agents. And we started to see audits tick up at that time, not just me, but my colleagues in the industry as well. And it's not so much a combative issue over us doing something wrong or their perception of us doing something wrong. It's an educational issue. They're new to the space as well. New hires through that tax program. And so we just kind of had to get them up to speed on some of the things we do and why we do it.
Yeah. I mean, that's great. It's great that you're providing that defense, but it's one of those things where doctors just get so nervous because, if they get audited for anything, it just kind of raises a lot of alarms. But it's good to hear that the cost seg wasn't the reason for the audit. It's just part of what they were looking at when they were looking at the entire return. And to be able to defend it with court cases and other things, there's nothing else you can do. So that's perfect. Okay, so this has been super helpful and valuable. Let's go to some questions we've gotten from our clients who knew we were going to have this conversation. And so they submitted a couple questions for you. Okay, so here's one. It says, Ali, many doctors lease instead of owning their building. And I'm thinking about my options for, to do that as well. Can a cost segregation study still benefit me if I lease as opposed to if I buy a building? I think that's a good question, actually. Yeah.
The answer depends on your ownership of the real property. If you're just renting, if you're just a tenant in the building, this cost seg is not going to help you. However, there are many times where you will go into a lease position, but add capital to the project. Like go do your own build out, basically. You may get, a cost per square foot stipend from the landlord in addition to what you're willing to put into it. So if there's a capital outlay associated with your lease, there may be opportunities to accelerate depreciation there. But if you're simply renting space, you don't own the real property, so there's nothing for you to depreciate.
So, Wes, let me make sure I totally understand what you just said. If I am going to a landlord, let's say in a shopping center or in a big building, and I say, I want this suite, it's 2,000 square feet, and I'm going to build my medical practice in there. And let's say there's nothing in there. It's just a warm shell, just 4 walls. Okay? Hot box, exactly. And I go in and I put in walls and plumbing and equipment and wiring and all that stuff. I build it out. Okay. Are you saying because I don't own the building or the suite, I'm just renting, that a cost seg would not be advantageous to me, or would it be?
In that example, it would be
Yeah.
because you're doing the build out.
You're doing the build out, right? Exactly. If I walked in and I rented a space that was already built out and I did nothing to it, then that's not so advantageous. What if I'm buying a practice and it's coming with all the assets of the practice? Could a cost seg help me there?
Most definitely. So you probably have a PPA associated with that, a purchase price allocation, where you're paying some amount of capital for goodwill, maybe the name of the business. Maybe some amount of capital is dedicated to the equipment that's associated with the practice.
Yep.
And then some amount of that purchase price is dedicated to the real estate that's associated with that practice. We would go and segregate that real estate portion.
Got it.
The other ones, you wouldn't need a cost seg study on equipment because accountants know what to do with that. And then, of course, you can't do a cost seg on goodwill in that example. But the real estate associated with it, we'd go in there and carve that out and find some additional deductions.
Okay. Good. Okay. All right. Let's go to the next question. It says, Ali, when a doctor saves a large sum through cost segregation, what are some smart, sound ways they can reinvest those dollars back into their practice without creating new liabilities? Question mark. Is there a catch? Question mark. So that, I think what's important here is I think there may be a misconception of what a cost seg is, because they're getting, like you said, a deduction off of their tax returns. It's lowering their income, but they're not getting necessarily.
It's not a credit.
It's not a credit. Yeah.
Credit.
It's not a credit. You're not getting money back.
Right. So let me just throw this example out there. It's kind of touching the upper bounds and limits of how things work, but for discussionary purposes, let's say you made $1 million on the year in your practice and you had no deductions and you paid top margin Fed tax rate 37%. You'd pay $370K to the IRS. That is a tax payment. It's a huge punch in the gut when you make that payment. How cost seg would work is you would make $1 million on the year, and let's say we found $1 million in depreciation deductions, all of which you were able to utilize because of your real estate professional stats. So you take that gain of $1 million, you offset it with a loss of $1 million, then you go to pay taxes on zero income. So instead of outlaying $370K, you outlay $0. Intuitively, you have saved money. You did not make a tax payment. So then if the question is, how do you invest those dollars? I mean, any answer is the correct answer. Stick it in a mutual fund.
Yeah. Go buy more property.
Buy another property. That's exactly. Order another cost seg study. I mean, there's a million ways to carve up how to earn on the savings, but it is not a situation where, you would earn heavily on the year and then conduct a cost seg study and somehow be in a credit situation.
Yeah. You're
exactly. If you made quarterlies throughout the year, you would get a refund, but we're not talking about, zeroing out your income and then providing you with the tax credit. That's not what this is.
Yeah, exactly. Yeah. For the person who asked this question, and for those of you listening, you're not going to get a check from the IRS in the amount of the cost seg. It just offsets the income, assuming, you qualify, as Wes said. And so, and if you don't have enough, then it just carries over to the next year and the next year and next year. Right, Wes? It just kind of
carries forward in perpetuity. Yeah. Can't carry it back. There was a brief period of time in like 2015 where they made some tax law that said you could go back and do it, but now it's all carry forward. So
which is great. Because you can use it in the future. Yeah. When you sell your practice or whenever you want. So there's no loss in that, which is very helpful. Yeah. And I think too, in terms of, I think there's a lot of people on social media, on TikTok, on Instagram, who talk about, I bought 5 properties and I paid 0 tax and now I'm going to buy 5 more. Even though a lot of that is nonsense, because, they're not telling you the whole thing. One of the things they're pointing to when they say I paid 0 tax, which is not always totally accurate anyways, is they're talking about doing a cost seg study, right? They're saying I bought 5 buildings or whatever. I did a cost seg. Their income was probably on the lower end, and they offset that income with the cost seg, which allowed them to save that money that they were going to pay in taxes, and then they try to reinvest it. So for those of you who are listening who are on social media, don't sign up for those classes or pay thousands of dollars for those people, those influencers. You just learn everything you need to know about that strategy.
He just took the mask off right there.
That's right.
And it's a deferment too. The word savings gets used colloquially, but I mean, this is deferring tax payments. Uncle Sam's going to get his. Try as you might. And unless you kick the bucket, you're going to end up paying taxes. Recapture happens at the end.
Yeah.
When in our earlier example, we had $1 million worth of deductions that offset the income. So you did not pay $370K in taxes on the year. When you go to sell the property, they're going to claw those deductions back. If you sell the property.
If you sell it.
If you don't execute a 1031 exchange.
Yeah.
If you don't put those proceeds into a vehicle like a qualified opportunities and fund or something like that.
Right.
If you take your chips off the table, tax bills come due.
It's coming to you. Yeah, exactly right. Exactly. So let's transition now to the last segment, which is called Plead the Fifth. Now, this is where I ask you a very uncomfortable question. Okay, we turn up the heat, Wes. Okay, you're in Houston, so you're used to the heat.
Yeah, you're turning up my heat.
That's right. That's right. I was actually, as a total aside, I go to Houston like 3-4 times a year, and I was there, I think, at the hottest day of the year, like 2 months ago, and man, it was brutal. I walked out of the hotel in Kingwood, just north of downtown, and I literally just was like a ball of sweat, and then just walked into the building, and then it dried up really quickly. It was pretty disgusting.
Yeah, it gets outside gets unpleasant here for a good chunk of the year.
A good chunk of the year. Yeah, it reminds me of when I was living in Washington, D.C. It's just the heat is crazy. But all right, so you can plead the fifth, or you can answer the question honestly. Now, no one has ever pled the fifth, so I don't want you to be the first. Okay, you ready for the question?
Bring it.
All right, here we go. It says, some people say cost segregation is basically a loophole for the wealthy, that doctors and practice owners are just gaming the system to avoid paying their fair share of taxes. How do you respond to that criticism? Do you see it as kind of smart tax planning, or is it, potentially crossing the line, even though it's allowed by the IRS?
I'm not going to plead the fifth. I'm going to answer this question directly.
Good job.
Everyone's lens back to, I don't want to make this a political commentary, but it's poignant here, so I'll bring it up. Hillary Clinton and Donald Trump were on the debate stage circa 2016. And she pointed at him and said, "This man does not pay his taxes." And he said, "That makes me smart." He doesn't pay taxes because he's a real estate investor. He's using the laws that are on the books to his advantage. I also feel that wealthy people should pay their fair share, but the laws are the laws. So there are few industries that touch so much of the economy as real estate does. I mean, to everybody from your lawyer to your broker to the guy that's going to swing a hammer on that place and fix it up when you get it done. And the more the tax code incentivizes transactions in that sector, the more people go to work. The Congress incentivizes with the tax code what it cannot do on its own, and that's create jobs. And so, I think loophole is an aggressive word. It's tax law. Many of the stances we take on component segregations, like moving a component away from the structure and into something that you can take advantage of, a 1245 asset category, is based on tax law. These things have been adjudicated. So It's really not like kind of going through or an interpretation of something in the gray area. I think it's based on tax law. So I understand the premise of the question, but I really think that the smart investor that is interested in preserving capital that they can then redeploy would execute this strategy. I hope that answers the question on its face.
Yeah, no, it does. And I love it because what you said early on, which I didn't know, and I think a lot of people don't know, which is that this is definitely something that is encouraged by the IRS because they want people to invest in real estate and whatnot. You're not skirting the rules. You're not dancing around stuff. You're not going to go to jail for it. There may be, parts of it that may or may not be, allowed if it goes under audit, but that's why they have US to argue on their behalf. And I agree with you. I think especially in people in high tax states, where they're paying, obviously the federal tax, but they're also paying high state tax. If you can save on your federal returns by doing a strategy like this with your real estate investments, which, as we all know, is one of the best paths to creating wealth in healthcare.
Preserving it.
What's that? And preserving it. Exactly. Yeah, and preserving it, then this is available to you, so which is great. So Wes, thank you very much for all this information. Your contact information is in the description. So for anyone out there who wants to get in touch with Wes because you want to learn about cost seg, you want to get a free analysis on your property that you've recently purchased or that you're thinking about purchasing, or you have a property and you're like, I absolutely want to do a cost seg, reach out to him and he'll give you all the details. I have personal experience with Wes, so I can tell you his team is great. They're very responsive. He's very responsive, and will take really great care of you. So Wes, any other ways for them to contact you? All your information will be in the descriptions, but any other way you prefer for them to get in touch with you?
Email, phone call, social media. I'm fairly agnostic. Reach out, ask a question. I answer them all the time. If you feel like you need to loop in your tax professional, we're happy to do that too. If you feel like you may be working with a tax professional who lacks some familiarity in the real estate space, I have an endless supply of contacts that I'm happy to put in front of you and let you interview them and pick the right one. But no, that's great, Ali. I really appreciate that, and it's very kind of you.
Yeah, of course. My pleasure. If you enjoyed this episode, please do us a favor and like, comment, or subscribe to Ali Off the Record. We enjoyed having you here. Wes, thank you so much for spending time with us. We'll see you guys around.
Thank you.